Markets fundamentals. Amit Premchandani joins us right now on the show from UTI Mutual Fund. Amit, hi, good afternoon, and thanks much for coming on board. You see, larger demand come from the rural market versus the urban market. Now, that has been true for many companies in the recent past, and a lot of them have been guiding for a similar trend. What is your rationale? What are the triggers that you think will actually propel the rural demand to be higher versus urban? Is it because it's an election year and the government typically tends to give out more incentives, more boost to the rural consumption?
What is happening over the last 2-3 years is the government is focusing on creating rural assets. So whether it is the government road program, the toilet program, or the rural housing program, all these are directed to create rural assets. So what we see is that volume growth in FMCG companies has been better in rural India as compared to urban India. Auto growth, especially passenger vehicles, have seen higher growth in rural India and some pressure in urban India. And now cement companies are also talking about demand largely coming from the low-cost housing program. All these are indicators that volume growth is largely coming from rural India as compared to urban India. However, on the other hand, we see significant pressure on the food inflation front as well as rural wage front, which indicates that the agri part of the rural economy may not be doing really well, while the asset creation part of the rural economy or non-farm part of the rural economy is doing really well. So government may have to intervene to give some boost to the agri part of the rural economy. We have been hearing of income transfer schemes being considered. We have heard the former CEA, Mr. Subramaniam, talking about universal basic income. However, given the fiscal constraint the government is in right now, it's very difficult to have a universal basic income scheme which is applicable universally. So there may be a directed income transfer scheme. Government as of now has been moving towards a progressive form of taxation, where direct tax rates have moved up through surcharges, while the indirect tax rates have been cut significantly, especially in mass consumption items through GST. In an election year, it is very difficult for government to increase direct tax rates further. So the only possible scenario for the government is to curtail expenditure and focus on more universal basic income scheme, income transfer scheme, and also allocate some part of the fertilizer or other agri-related subsidies toward this income transfer scheme. That is what we expect the government to do.
All right. Talk to us a bit about the FMCG pack. The results so far have been largely okay. The volume growth has been fairly healthy. What is it that's making you a tad bit of cautious with regard to the space? Is it the high valuations or any other reasons?
FMCG are a very, the sector is a very well managed sector, very sound corporate governance practices. What is concerning to us is basically valuation. What we look at is what are the valuation implying in terms of growth going forward. And what we see is that many of the FMCG companies are implying growth which is significantly higher than the last decadal growth in terms of volume. The two key themes in FMCG which drives the sector are penetration and premiumization. Penetration in many of the sectors have have gone up significantly, while premiumization continues. So as a sector, we are not negative per se. It's just the valuation which is kind of concerning to us.
All right, all right. Talk to us a bit about what your perspective is on the cement pack. My colleague Vivek was just with us. He was talking to us about the various headwinds that the sector is facing. The price hikes taken are not sustainable. Volume growth is also moderating on the high base. Given these kind of headwinds, how do you, perceive this whole space? Is it a good idea to stay invested in cements at this point in time?
We have to be stock specific in cement. mainly because over the last 1 year especially, we have seen many companies announcing capacity expansion. The expectation was that as demand growth has picked up, we have seen double-digit volume growth. It will be followed by pricing increase. However, we have seen that is not happening as everybody is bringing in new capacities. There are pockets of country where we have seen some price increase. For example, northern markets have seen some price increase, but large part of India have seen pressure on pricing. While over the last 1 year, crude prices have moved up, and hence the cost pressures have been very high on the cement companies. It is important to note that 60% of the cost of a cement company is linked to crude or crude derivative, and we have seen that cost matrix inching up. In the last 2 months or 3 months, we have seen crude prices correcting. So we may see some 3 to 4% decrease in cost per ton in the cement for the cement companies. But the other concerning factor remains that capacity utilization is still at 70% for the cement sector per se, and at that percent of capacity utilization, we are seeing a lot of capacity announcements happening. Hence, pricing power is getting eroded for the cement as a sector. So we will be very much stock specific on the sector rather than giving a sectoral call on that.
Hey, Amit, thank you so much for chatting with us in details about the sectors that you're bullish on and are also cautious on, and sharing with us your perspective on markets.